Welcome back everybody to my YouTube channel. I hope you're enjoying the content, and as I always say, if you are, drop us a like, subscribe and turn on notifications. So this is a huge mistake I notice from a lot of price action traders. Now they come into Forex and they read a book or two, they watch a few YouTube videos and then they get to work. Now their exposure to candlestick patterns is probably so overexposed that they end up believing that that's all they need into becoming a profitable trader. Then that leads to them trying to memorize as many possible patterns, and then they take that knowledge into the markets, place a few support and resistance lines, and then trade. Now, unfortunately, you will find as time goes on, it doesn't work like that. Now, I always say that yes, in life, knowledge is definitely power, but too much knowledge in Forex is poison. So, focusing on candlestick patterns alone is not going to help you. In order to become a consistent and profitable trader, you need the backing of Confluence. Using candlesticks alone is a recipe for disaster. So what exactly is Confluence? In its simplest form, it's tying everything together, making sure that you have a solid approach to increase the odds of you becoming a profitable trader. So in this video, I will show you 3 examples of how you can do this. Let's move on to the chart. Okay, so we're over at Euro CAD. Now, I don't want you to focus on the actual currency pair we're trading. I just want you to notice that we're on the weekly time frame. So what I'm about to show you now is going to be more for those that are swing traders. Okay, I'm not here to teach you a strategy. I'm just here to identify Confluence as a potential swing trader. So on the weekly time frame, as a swing trader, what we're going to be looking for is major levels in the market where price is reacting to the most. So let's drop them in. So let's pop our first one here in and around this level. Now what we're identifying is wicks, 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 wicks. Okay. Again, we'll drop one here. We'll take into account as much of this information as we can, and we have wicks, 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 wicks. Let's see if we can find a final one. And we have one down here. These are our levels. Now, as you notice, we don't need too many. We have our levels. Now, before we move on to anything else, let's identify what's happening on this market. We can clearly see the structure of this market is down. That's a no-brainer. Next thing, we can see that price is making structural highs, lower highs, lower highs. That technically should mean that when we look at the structure in the morning or in the afternoon or at the end of the day, we should be saying to ourselves, based on this structure, at this moment in time, I am looking for sells. Let's remove those last 3 lines and let's move down to the daily time frame. Now, once we move down to the daily time frame, you can see this much more clearer. Okay, so when we scroll back, what we can see here is the levels that we've drawn in where price is reacting to the most. Okay, our support line here, we see price reacting to the most. And then finally, our target level, which is this major low here, is where prices come to now. Now, again, I'm not focusing on trying to teach you how to trade. I just want you to identify Confluence with the higher time frames and stepping down to your entry time frames. Now, the rule of thumb, if you want the honest truth, is 1 time frame for your major key levels, 2nd time frame, which should be 1 lower for your behavioral patterns, and then your final one, which is going to be used for your entries. 3 time frames only is all you need. Okay. So let's remove this line. So what do we notice here? Well, let's look at this price action. These are our key levels. Now remember, these key levels came after price action has moved. So what I want you to focus on is how we potentially would have looked at this. We have on the weekly time frame structure moving to the downside, meaning we're taking sells only. We're now looking at this time frame and we're identifying a major key level in the market where price is reacting to now. Now, I want to make this point. Just because price comes back to these levels, it does not mean that we're immediately looking to sell the market. Now, this is a behavioral time frame, which certainly means that all we're doing is looking to see how price is reacting in and around those levels. Okay, what we're noticing now is we have lots of wicks forming, which in itself is a confluence. So not only do we have a bearish structure, we now have wicks forming at a key level in the market. But what we need to look for is an entry. Now, the only way we're going to get an entry is if we see the behavior of this market on our entry time frame moving in a direction or the overall direction of where the market is going, which is down. So let's mark this level here. We have here evidence in the market what price is reacting to. Let's see if we can collect enough evidence along with the two confluences we have to look for a potential entry. Now, moving from the weekly to daily, remember we said we only need 3 time frames. So let's move on to the 4-hourly time frame. When we scroll this chart back, what I want you to identify here is the circle that we put was from the daily time frame. This was used to identify a key level in the market where price was reacting to. Now remember, whatever behavior happens on this time frame, it doesn't mean that this structure is broken. The only time structure is broken is always on your key time frame, which is the weekly time frame. Now what we notice is price is broken, structure broke back into structure. We have a reaction level in and around here from the daily time frame. 4 hour, which is our third time frame, is our entry time frame, means we're looking for our entries. Now what we're looking for when we go down to this time frame is not how price reacts now, but how price comes away from this level and comes back and then reacts. This gives you a third confluence. First confluence, as you can see here, we have our bearish structure. Secondly, as you see here, we have our major key level. Thirdly, we have a level in the market where price is reacting to. And then finally, we have price leaving structure and coming back. Now, does this mean we're looking to enter as soon as price comes back to this level? Well, again, no. What we need to start seeing forming is reaction from this level. That could be wicks, that could be bearish candles, that could be pin bars, dojis. I really don't care. I'm not here to teach you entries. But notice, once we have enough confluence, we can now look to take the trade. Whether that's using this pin bar, whether that's using this bearish candle, whether you're looking for the breakout, whether you're waiting for a pullback, for a sell limit, a sell stop, I don't care. The point is you have entries. Now, we've built enough evidence to know that even if we're not the first in this trade, we know how structure works, and you can look to sell these structures here, these structures here. If you got caught out here, that's fine. Remember, you're using risk management, so you wait for a re-entry. If you don't take any of these trades, you can look to trade here, you can look to trade here, and you continue doing that until price gets to a major level or the market decides to reverse in the opposite direction. And as you can see, our major key level that we found on the weekly, price is tapped into almost bang on and then left the market. It has continued down up till now, but the point is it made it to that level. Now this range is absolutely huge because this is a swing trade, and the potential on this trade, as you can see, is almost 380 pips, what it is, +1. So that's how I would look for Confluence as a swing trader using the weekly, daily and 4-hour time frame. We'll just recap this. The recap is identify your key levels. See where price is reacting to the most. Then you want to be looking for the directional bias of the market. Once you find the directional bias of the market, you then want to go down to your next time frame, which is your behavioral time frame, and you want to start building confluence on how price is reacting at these major levels. Does not mean you're ready to enter yet, it just means you're monitoring the behavior. Once price signifies a continuation after a potential pullback or reaction from a major level, you can then move down to your lower time frames, your lowest time frame, should I say, which is going to be your entry time frame. As we can see, we have another confluence of the wicks. We have a next confluence of price leaving the level and coming back, and then we're looking for our entries in any which way we trade. That's confluence as a swing trader. So let's move on to intraday trading. Now, what is intraday trading? In its shortest form, it's literally trying to get into trades within a period of 24 hours, in and out. We're not looking to hold them overnight, and we're not really planning to hold them over the weekend, if at all, ever. So what we do as an intraday trader is we look to get into the market to take advantage more of momentum more than the swing. So when looking at this chart, what we got to identify again is how price is reacting. On our previous example, we saw that the market structure was clearly going down. With this illustration here, what we can clearly see on this market structure is that the price is moving sideways. For that reason, what we have to do is mark our major highs and our major lows of this market structure. And now we get a true directional bias. It's ranging. Now, what's the criteria for trading ranges? Everybody's is different, but mine is to make sure that price comes to the major highs if I'm looking to sell, or come to the major lows before I'm looking to buy. So that being said, we have our key levels using the 4-hour time frame. And what we'll do is we'll move over to our behavioral time frame, which is the 1-hour chart. Now, once we're at the 1-hour chart, things become a lot clearer. Now, I want to say that a lot of you, and for those that are skeptics, will say, well, you know what, Rocks, this has happened. It's easy to say. Well, no, it happens every single day, every single week, and every single month. So if the patterns repeat, then guess what? We just have to forecast that that's what potentially could happen, and we take the trade. Okay? So again, it boils down to evidence. And once we start to see price giving us the evidence that it's reacting from major levels, what we then have to do, and even to the downside, what we then have to do is we have to wait for price to come back to these levels. Okay? So the confluence here is that price is giving us a true directional bias, which is sideways, and we're getting the rejections that we need in order to identify bearish pressure, or if we're looking at it from the bottom, bullish pressure. Now, does that mean we're taking a sell immediately? Well, no, this is our behavioral time frame. What we'll do, we'll take a look at some of these levels here and these levels here so that we can identify a sell opportunity when the time is right. The confluence is the market's moving sideways, but we're getting the evidence that it's reacting to major levels. And when selling a range, what we're looking for is for price to come to the major highs, or when buying a range, looking for price to come to the major lows. Let's move on to our entry time frame, which could be around the 30-minute or 50-minute time frame. So now we have price coming back to these levels here, and just like I gave you an example on the previous time frame, once we get a reaction from the market structure, I wouldn't rush to sell now. What we have to allow price to do is leave that area for a period of time, come back to the area, and then look for our evidence. So with this, we have three confluences. The market's moving sideways, clearly identifying to us it's reacting at a major key level, both to the bottom and to the top. The range is clean. Price on our behavioral time frame is giving us evidence of wicks showing bearish or bullish pressure. And then on our entry time frame, we can see a little bit more behavior. And then however you decide to take this, again, I'm not here to teach entries, but you can look for your dojis, you can look for your pin bars, you can look for your bearish engulfings, bullish engulfings, whatever it is you use to enter the markets. Again, just remember when going for your targets, you're always going to be looking to target, if you're an intraday trader, not your key level, but the risk to reward ratio that you decide to choose, which mine is 1-3. If yours 1-2, 1-1, 1-3, whatever it is, that's what you're going for. Don't get greedy and say, well, this range is enough for me to get 1-9. Forget about it. Get in the markets, get out as soon as possible. If we look over here, we can see that the market came back to this level after a period of time, after it bounced off the low of this range. It came back, started to show evidence and confirmation that price is failing to push up. We see a lot of wicks to the downside, and that's truly identifying to us, along with all the other confluence we have, that the market structure wants to go down. Do we know it's going to win? Absolutely not, but we're going to do our best just to take the trade in a systematic way and repeat the process over and over again so that our wins balance out and cover our losses. So just a recap, the confluence as an intraday trader is slightly different because we're not targeting major level lows or highs, but we're looking to just get in the market to try and get our risk to reward ratio snapped up as soon as possible within a period of 24 hours or less. The confluence that we have here is the market structure is clearly moving sideways. We see that price is respecting the major structural highs and lows of this range. What we're looking for is wick rejections. We have the wick rejections. Once we move down to our behavioral time frame, what we got to wait for is for price to show evidence that it's failing to break above structure, allow it to leave structure for a period of time, come back, and then show us signs of wicks again. For our entry time frame, we can see that in more detail because the candles break down, that we had strong bullish pressure into structure, it's failing, we now have the wicks, and then however you decide to enter the market is certainly down to you. So that's intraday. For our final example, we'll look at scalping. Now, I'm more of an intraday trader as opposed to a scalper, but the concept's the same. However, as a scalper, what you're looking to do is literally take advantage of momentum at the finest level, meaning that you literally want to be in and out of the markets as soon as possible. So what we'll do is we'll use the hourly time frame as our time frame for our key levels. But more than so key levels, we're looking to identify momentum. So what we're looking at here is a structure on this market that is clearly going down. That means at this period of time, we are only looking for sells. When looking for sells, we need key levels to work with, because what we need to happen is for price to react off those key levels just slightly enough for us to be able to manage our trades and to take advantage of a scalp. So when we're looking at this level, we can see here, we have a major level in the market where price is reacting to. Here, we have a major level in the market where price is reacting to. And here, we have a major level in the market where price is reacting to. So let's move on to our behavioral time frame, which more often than not is going to be around the 30-minute time frame, and take a look at this properly. Now, we know that the market structure is down. That's Confluence number 1. We have wicks on this market to identify bearish pressure. And what we need to happen is we need to allow for price to come back to our key levels to start showing us signs of wicks, bearish pressure, engulfing candles, pin bars, whatever else is you're using. So let's take a look at this market structure. Price is pushed down. We've created a level here on the market where price is attempted to pull back, probably a small exhaustion, and now we're looking for a continuation. We have this continuation on this market structure. Now, just to let you know, once price pushes back into this level, this is a potential level in this market where we can look for sells, because again, it's left and come back to the major key level. And what time frame are we looking to enter this market on? Well, as a scalper, you're probably looking for 1 minute or 5 minute time frame. It's really up to you, but let's take a look at this. Price has now come back to this level, and you can see on the entry time frame, remember that we have beautiful rejections here to identify a potential trade. So let's take a look at this trade. Say you plan to enter this trade at the close of this candle here. What we'll do is we'll have a stop loss, let's just say just above structure. Make sure it's just above structure. And as a scalper, you're probably going for maybe 1-to-1 or 1-to-2. Let's see what you would have got out of this anywhere at the low. We don't know it's going to close there, by the way, but let's just see. Just with this example alone, you're probably looking at around 2.5-to-1 on this trade. But notice the confluence that lined up was from our key time frame, moving down to our behavioral time frame, identifying bearish structure, identifying a key level where price is reacting to, and waiting for price to come back to that level to look for your rejections. Okay, now let's continue this. We're back to our behavioral time frame. So price now obviously gives us a reaction here for a quick scalp of maybe 2-to-1, 2.5-to-1, whatever it is. Let's say you missed this opportunity. Now, we don't know that this is a key level yet. And being brutally honest, if price starts to push up and violate these structures, more often than not, you're going to be more bullish than bearish, but you're not looking to take buys just yet. What you need to see now is how the price starts to react. After this price action developed here, we see a lot of wicks on this market structure, and then we had a massive pump back to the downside. Now, we can see that the bearish sentiment is still evident in this market. We're still going to maintain our key levels where price is reacting to the most. We have a reaction here, a reaction here, a reaction here, a reaction here. And what we can do is we allow for price to leave that level to come back. And then what we can start doing is scaling down to our entry time frame to see if we have tradable opportunities. Now, remember, once price comes to this level, we're not looking to enter immediately. What we want to do is see how price leaves this level, comes back to this level, and then potentially look to enter the trade, something like this. Now, to be honest with you, again, this is going to be a scalp. I don't know if this is going to be an entry for you in terms of this being a very big candle, but even if it is, you're still targeting a 1-to-2 risk reward ratio or potentially a 1-to-1. Let's go for a 1-to-2 on this and see what happens. You probably would have been sitting in this trade for a period of time, but as you can clearly see, take profit was hit on this, no problem whatsoever. Again, I'm not here to teach you entries and I'm not here to look for targets. What I am trying to illustrate as a scalper, it's the exact same process. You are looking to find out the direction of the market, the phase of the market, your key levels, how price is reacting at those key levels, and waiting for price to leave those levels and then come back to look for tradable opportunities. So 3 examples there: swing trading, intraday trading, and scalping, all very similar in terms of concept. Understanding that swing traders obviously can go for longer and bigger targets. They may have bigger stop losses, but of course, over the long run, their risk to reward ratio is going to be much greater than ours. Next, we have intraday trading, where we're looking to get into the market as soon as possible and get out within 24 hours. We're obviously going to take a lot more trades, but that's completely fine. We just manage that with our risk to reward ratio. And then finally, you have scalping. We're looking to get in and out of the market and take advantage of momentum when momentum gives us evidence and confirmation that prices reacting at major key levels. That's how I see Confluence. I hope this has helped you. And if so, have a great trading week. And until the next video, take care. Oh, drop a like and subscribe. Take care. Bye-bye.